The FOMC's assessment that it can be patient in beginning to normalize policy means that the committee considers it unlikely that economic conditions will warrant an increase in the target range for the federal funds rate for at least the next couple of FOMC meetings.
As we welcome you back to America's Forum, you were welcomed by Janet Yellen, testifying about the Federal Reserve's monetary policy report at the end of February. The chair of the Federal Reserve determined that economic conditions do not warrant an increase in the interest rate, but there are people who believe that such low interest rates could lead to the death of the American dollar, or sometime, somewhere, a dramatic increase in rates, I guess economic whiplash. But enough of my assessment. Let's get the real assessment from radio personality and Newsmax insider Lowell Ponte. Lowell also is the co-author of the new book, Don't Bank on It, The Unsafe World of 21st Century Banking. He's Skyping in from a great place, Carlsbad, California. So, Lowell, you say the Fed is trapped in a zero interest rate policy world. By that, what do you mean?
I mean, back in 2008, as Lehman Brothers had collapsed, as other banks were teetering, the Fed decided it was going to save us by jamming the pedal of what it could do all the way to the floor. What it could do is lower interest rates. It lowered them to zero. You remember those episodes of Star Trek where the Starship Enterprise would get in trouble and they'd say, go to the highest warp we've got. And they'd warp and they'd get out of the trouble, and then suddenly they'd look around and say, but Captain, our star maps no longer work. We don't even know where we are anymore. We don't know how to get home. Well, what they did in 2008, they warped us into a very peculiar new economic system. It ain't capitalism. It's one where big banks and governments get their money absolutely free. Big corporations get their money almost free. But you and I are now paid almost nothing for saving money in the bank. A whole lot of people are hurt badly by zero interest rates. And so they've known they can't stay in this place. But can we get out of it is the question. Government has now borrowed so much money that for every 1% you raise interest rates, you increase the tax burden by, what, $500 billion just to pay the interest on all this. So they can't let the rates go up. They can't let well, they are letting the rates go down. In fact, in Europe, they now have negative rates. They now charge you for having a bank account. And what this has done for business in the country, for big corporations, they've made it really cheap to keep part of your company in the U.S. because you can run it on borrowed money that isn't taxable, but then you take everything that would be taxed at the average business tax rate here, which is about 46.3%. When you add in state income, state tax on business, federal tax on business, and so on, you've created this enormous incentive and easy path to take your business and jobs out of the U.S. And so is this good for us? No, it isn't particularly. What I would expect is before the end of the year, the most the Fed will do is raise interest rates by 0.25% just to show people they're not going to leave us here at zero forever. There is theoretically a way home, but in the meanwhile, they've given us what one economic writer calls economic diabetes. They have given us a perpetual sugar rush.
Well, mindful of that, and from sugar back to your Star Trek analogy, of course, on Star Trek, there was the Federation. Here in the real world, we've got the Fed, the Federal Reserve. Now, your comment is that the Fed is essentially the unelected fourth branch of government. Explain that perspective, would you, Lowell?
Well, that woman you were showing at the beginning, Janet Yellen, she is arguably the one U.S. official higher than President Obama himself. Because if she utters 2 or 3 words, she can make markets go up and down all over the planet. She can stop investment or accelerate investment. Tremendous economic power in the Fed. This came to us through progressives 100 years ago. And since then, the value of our dollar has plummeted. Remember, the Fed was instituted to protect the value of the dollar. Your dollar today has only about 2 cents of the dollar purchasing power it had in 1913 when the Fed was authorized. And the Fed was authorized to create a flexible currency, an elastic currency was the word they used. So they wanted to make funny money that the government could more easily spend, that the government could more easily produce. They wanted to get away from that nasty old gold standard in our money that had made us the strongest currency in the world, and that meant the government couldn't just print all the money it wanted to implement programs. So all that got changed. And what we now have is an economy that, whatever else it isn't capitalism. It's a handful of people deciding what the money is worth. In a free market economy, interest rates would be in the range of 5 to 6%. Today, they are 0% or below.
And mindful of that, in the here and now, and I think about my kids and other kids going off to school, President Obama last week, or actually earlier this week, was down in Atlanta visiting students at Georgia Tech. Let's listen to what he had to say and then get your reaction to it.
Student-aided Bill of Rights. And it says every student deserves access to a quality, affordable education. Every student should be able to access the resources to pay for college. Every borrower has the right to an affordable repayment plan. Every borrower has the right to quality customer service, reliable information, and fair treatment, even if they struggle to repay their loans.
Lowell, the president is calling that his Student Aid Bill of Rights. What do you think of it, and what do you think about the state of student loans in the United States?
Well, it's about as surreal as the way companies now in the stock market are using easy money to jack up stock prices just by buying stock back, not by actually doing anything. What we are seeing done in our campuses now, the president wants to make bankruptcy easier for the 40 million kids who have student loans. Average student loan for a graduate is more than 28% or $28,000, meaning they're going to be carrying debt into their earlier lives that will stop them from buying a new house, stop them from buying a new car. It's going to cripple the economy. The only catch is 90% of student loans are with the government now. So what the president is actually proposing is a system where you can't declare bankruptcy if you have a government loan, but you can if you have a private loan. This is part of his ongoing effort to totally nationalize the institutions of universities, the implementation of student loans, the gratitude and indebtedness students will have. And don't forget, this is the Barack Obama who said you can get your student loan forgiven if you get a government job of certain kinds, or
yeah.
if you become a political activist, you can get your student loan forgiven. But if you go into private business with your degree, well, you'll have to pay that whole loan.
Well, on that note, we will have to thank you, Lowell Ponte. Again, the name of Lowell's book is Don't Bank on It, The Unsafe World of 21st Century Banking. Whether it's student loans or the de facto fourth branch of government, the Federal Reserve, Lowell, we thank you. And here's a Newsmax Now update.